With the stock market down, you might be wondering, what can I do to stop the pain and take advantage of the situation? I've got three things for you to consider when the market is down. The first is to take a look at something called tax loss harvesting. If you are someone that has investments in a non IRA account, often called a brokerage account, the way that you pay taxes is when you sell the stock, the gains that you have inside of that position, the investment you have to pay taxes in that tax year. Now, if the stock is down, you can do what's called tax loss harvesting. That loss will show up on your taxes, and that should be a help for you for that tax year. If your stock is down with your investment being down, you can tax loss harvest those losses inside your non-IRA account. Now, there is something called a 30-day wash sale rule. You can't just sell at a loss and then have that loss show up in your tax return and then you buy the stock the next minute. You can't even do it the next day or even up to 30 days. But quite often what you would do then is you would sell the investment that you have now, and instead of keeping it in cash and seeing what happens with the stock market up or down, you would find something that's similar that would hopefully perform as well on the way up as your stock, if that happens to be going up and you just happen to sell out of it for the tax lost. Here's two common examples. Imagine you happen to own Coca-Cola stock. If that happens to be down and you sell it and you're thinking, I want to have my new investment go up when Coca-Cola goes up, well, what might be a similar type of stock? Pepsi, that's a stock that's in the same soda beverage market. Perhaps those happen to go up in tandem. They're different, but they're similar. And I'm not recommending buying or selling either one of these, but that's the idea, is you want to stay invested, but take advantage of that loss. So you find something that's similar but different. That's an idea. Another common example is the S&P 500. It's the top 500 stocks that are out there in terms of how big they are. And you might be invested in an S&P 500 index fund. When you sell that index fund, perhaps you look at a fund that's based on the Russell 1000 index. It's similar, but different. You've got to figure that you've got the top 500 stocks in the S&P 500, the biggest 1,000 stocks in the Russell 1000. You got to figure they go up and down somewhat similarly, not exactly, because they are different investments. They won't have the exact return, but perhaps that's an idea of how it works for you on this idea of you take advantage of the tax loss, but you still have your money invested. So that's the number one. You take a look at that tax loss harvesting, where you might sell an investment in your non-IRA account at a loss, and then you buy a similar but different investment. You're not changing your investment mix. You're not selling to cash. You stay invested. You haven't changed your risk at all. You're just taking advantage of the loss. The second thing to consider when the market is down is something called a Roth conversion. You might have money in your traditional IRA accounts, and if you had a certain amount, let's say, example, 100,000, you had 100,000 at the start. If the account's down 10%, well, now you're at 90,000. When you convert over from traditional to Roth, you pay the taxes on that taxable income on whatever the dollar amount is that's converted over. So maybe you had 100,000 in the traditional to start. If it drops in value now to 90,000 and you convert to the Roth IRA, just assuming right now you convert everything, you convert that entire amount, that conversion amount that's taxable shows up at the 90,000 level, or whatever the value is that day. It's not the 100,000 level. You convert the same amount of shares that you had earlier. It's the same investments that you had earlier, just that your investments, the pricing of it's down by 10%, as an example there. Now, if and when the market returns back to where it was, now that growth back up to where you were, because you converted at the lower level, that growth up to where you were is in the Roth IRA, growing within that tax-free Roth IRA. So when the market is down, consider how and when you might do a Roth conversion. I've got the third thing for you to take a look at when the market's down, but it's important to make sure as you're planning for your investments and your retirement planning that you have a process. I put together a 5-step process for you to follow on how to create your retirement master plan. Head on over to 5stepretirementplan.com. I'll show you 5 videos on how to put together your retirement planning. The third thing to consider when the market is down is to make sure you have the right amount of risk. I don't think it's ever a bad time to make sure you have the right amount of risk, that you have the right level of stocks and bonds. And there's kind of two ways to look at that. One of them is that if you had a certain level, perhaps let's say 60% in the stock market, and then the market goes down, if the stocks go down more than the bonds, now your percentages are maybe off. Maybe you have less in stocks than you had before, and maybe even less than what you wanted to have. You might want to consider rebalancing by you take the areas that are not down as much, or maybe they're up, and you take that money and you rebalance it on over to the other areas. So perhaps bonds to stocks if the market's down. All you're doing is trying to get to the point of what you had to begin with. That's called rebalancing. When things move around, you bring them back into balance. So you might want to consider it. That's the first part of the idea of looking at the level of risk you have in your investments. The other part is that it's usually a good time to have the right amount of risk. It's almost always worthwhile to make sure you've got the right level of risk just in general. And the issue comes in when the market is down a little bit. What do you do? I met somebody back in 2008. So this is the great financial crisis. She told me she was a conservative investor. I looked at her portfolio and it was not conservative at all. It was highly leveraged. She didn't even know what leveraged portfolio meant, but that's how it was invested. That's how the person that was investing for her had set it up. And I said, you've got way too much risk, more than you thought, more than you wanted, but it was down 10 or 15%. I suggested you get to the better level of risk because you ought to be in the right level of risk for you with your investments. Well, she responded back to me. She said, I'm down 10 or 15%. I'll change things around when I get back to even. Well, I met with her about a year later. We're talking spring of 2009. Her investments by then were down 90% because she had too much risk to begin with. She was over leveraged and she had no idea if the market's going to go up or down when we were at that being down level. She was down 10 or 15%, said, let's get back to even. And she missed an opportunity there to make sure she had the right level of risk. I'm recording this on April 24th, 2025. I'm telling you that. You're not supposed to say, here's the date that we're recording a YouTube video, but I'm recording April 24th. As of right now, the S&P 500 is down 11% from its high point earlier this year. And it sounds like the stock market is down. It is compared to the high point. And you might be saying, I don't want to sell at a loss. I don't want to get out of stocks because the market is down right now. But I encourage you to think about 12 months ago. 12 months ago, I looked it back. 12 months ago on April 24th, 2024, the stock market's up 7 percentage points since then over the past 12 months. So just because the stock market is down from a recent time period doesn't mean that's down in the long run. If I was talking to you a year ago and said the stock market's near an all-time high, it's April 2024, it's near an all-time high. Do you want to get to the right level of risk? Do you want to sell some of your stocks, buy some bonds or cash because you've got too much level of risk in there? You might have said that's a great idea. Well, here we are 1 year later with the same point in the stock market as we were a year ago. And I'd encourage you to consider, do I have the right level of risk? Yes, the recent time period happens to be down, but the market's not down in the long run. Take a look at the level of risk that you have. And even though the market might be down in the past few weeks, past few months, you want to consider getting to the right level of risk, whatever that level might mean for you. Hi, I'm Jeremy Keil with the Keil Financial Partners. If you'd like to see how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, head on over to keilfp.com. That's KEILFP.com.